Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Pod Zabriskie.
Welcome into another episode of the Money Insights Podcast. I'm your host, Christian Allen, and with me, as always, Pod Zabriskie. Rod, what's up, man?
Hey, I am doing great.
I'm ready. Pretty good too. You're ready? Okay, so the question is, Rod, what are you ready for? Well, let me just tell you.
I don't know yet.
Today, we have a little bit of a surprise. It's a surprise for you as the listeners, and it's also a surprise for our friend Rod today. Today's episode is going to be, what would Rod do? So we have just like this source of incredible wisdom here, and we just got to take advantage of it. That's my thought.
Boy, no pressure.
You might have to put on several hats today, Rod. It could be an economist. It's going to be your dad hat at moments. It's going to be your financial planning hat. It's going to be your investor hat. We're going to get all of the hats on, but not at once.
Okay. Yeah, that look a little silly.
Yeah, that would look silly. Anyway, so it's going to be fun. Just to lay it out, we're going to ask Rod a bunch of questions, some scenarios. We'll get as deep into them as it makes sense to get into. We don't really we're not in a rush. So we'll go through as many of these scenarios as we want to, as is really creating value. And Rod has had no preparation whatsoever. So he did not know about the topic of the podcast until just minutes ago. Okay. I think I laid it out.
I'm ready.
Are you ready?
You're
see.
Ready.
Okay.
I guess we'll find out, but
I guess we will find out. Okay. I think you're ready, Rod. You got this, man. This is like, you live in this space, so I have a pretty good idea that of what kind of stuff we'll get. Okay, here we go, Rod. We're going to start with some real life financial, we're going to call them dilemmas. Maybe they could just be events, really. They're just financial moments that happen. Okay. And if you want to ask me clarifying questions, I'm happy to make up some stuff for more context. Sound good?
Sweet. Yeah.
Okay. Real life financial. I don't know why this is a dilemma. It's not a dilemma. You just inherited $500,000. What do you do?
Oh, I mean, I would invest it. And the reason I say that is because I feel like so much of my life is built around what can I carve off of the money that I have that I'm not paying to taxes, that I'm not just spending on daily living. And I mean, we've talked about this in the past. We don't like necessarily scrimp. Like we still travel, we still do things, but I want to be carving stuff off. And so I feel like right now, and just in the mindset I have right now, if I had something like that land in my lap, I would be so excited to go out and invest in some things that I just feel like I haven't been able to because money is tied up somewhere, or I have just not feeling like I'm carving as much off as I'd like to.
Okay, I see. So it's almost like catch-up time. Like if you're like, hey, I save, I invest a lot of money. However, it always feels good to like juice up the savings, juice up the investing, right? Okay, so you're saying you would invest it. Well, I think that is probably obvious, Rod. You got to get another. We're going to have to take this thing another level deeper.
Okay.
And my follow-up question is, well, great. How are you investing? Like, what are the things specifically that Rod's doing? And again, we're just going to let this be you, Rod, your current living situation today. What do you do? How do you invest?
Well, there are categories or things that I would like to have been investing in recently, and I just haven't had additional capital. I've already invested my capital that I have.
Okay.
And so
I've heard cryptocurrency. Are you going to throw some in the crypto world?
Yeah, so crypto is definitely one. And this would have been nice to have this conversation 2 months ago. Maybe 2.5
before it blew up.
But yeah.
But hey, it'll probably blow up again. So here we go. You know,
that's the kind of the vibe that's coming across there. So there's that. But then also other syndications and even categories of syndications. The category that I have been in is multifamily, and gratefully in a couple of different places, because again, I have money locked up in one place with question marks, and I have another one that's it's just still in development phase. They're still kind of building it out. And so I don't have any cash flow from it yet, but that was expected. Right.
Okay.
Um,
Okay.
But then other categories like self-storage, right? I'm very intrigued on the STR side. I haven't invested on that side and would like to figure out a way to do that. So those are some of the things.
So those are some places you might go. Would you consider a business?
I would consider a business. There are actually there's a group here locally that gets together and does like an angel investor kind of opportunity thing.
Okay.
I just haven't ever pursued it.
Here's a thought just as a follow-up, Rod. What would kind of your breakdown of like, maybe like in terms of aggressiveness, what are you going to do with because so now we've got the 500 grand. We know you're fine. So you're not needing to like go pay off debts and stuff. You're going to go and invest the full 500 grand. Knowing of course that there will be, actually, I shouldn't say knowing there will be some taxes, because if you inherited it, will depends on what the inheritance.
Yeah, I was hoping not, but yeah, if it's an IRA or something like that. If it's an
IRA, then that would be. So we'll just say that it's that you got a step up in basis from a real estate from a like your grandmother's house, and now all of a sudden you got 500 grand. Okay. So how are you investing it in terms of safety levels? What does that look like?
Yeah, I would put it in a well-diversified portfolio of property. I'm kidding.
Okay,
good. I mean, I think that's the way I would put it. I would probably say at least 20 to 25% of it I'd be willing to put into something that's pretty risky. So going back to the whole business thing, I really feel like, and again, this goes back to my kind of Shark Tank thing. Mm-hmm. As I've watched it forever, it's been like 15 years or something.
Yeah, it's been on a long time now.
And then just so there's been some maturity in the process to go for them to go back and look and see how did you really do. Mm-hmm. And I think with a few exceptions, the product opportunities have not been as lucrative as probably some of the other, which is probably expected, right? The tech side, when they go big, they go really big.
They go really big. Yeah.
And some of that is priced into what they've paid for it. Big, just because that's kind of the world we live in now with the way tech companies get priced. But either way, so I would maybe take 20-25% of it and put it into a few opportunities like that I felt like were, could go big. But then the rest would be kind of some of those things that are just creating some good cash flow. And maybe a couple that are more appreciation focused, because I do still have time ahead of me before I'll be ready to just live off of the cash flow.
Need to take the cash flow. Yeah.
Yep. So
okay. I think we got it on this one, Rod. That was good advice. So listeners, take Rod's advice. He's like, what? You're late 60s now, and you have. No, just kidding. How old are you, Rod? I forget. 40.
We're gonna hang on to 49. Yeah, well, I
49.
So.
Yeah, a young 49, by the way, still out there playing basketball. So, and by the way, have I told the story on air of you diving on the football field?
Yeah, I think so. But
okay, well, maybe I'll just revisit it and then we'll move on, because Rod will never live this down. This was like 10 years ago, though. We decided to go and help. We were going to throw with a aspiring quarterback, right? He needed people to throw to. So we're like, sure, we'll get the exercise and throw. Then we're playing a little 2-on-2, 3-on-3 football it was inside on AstroTurf, like cement, then AstroTurf. Mm-hmm. We're going, Rod was really going. And at one point, I don't remember the circumstance, but Rod was willing to lay out. He dives. I don't know if we should.
You broke away. You broke away.
I haven't broken away in 20 years. But I guess maybe I broke away from Rod and he laid out for it. Anyway, so he's committed. Okay, let's get into scenario number 2, because we don't want to get too bogged down here. I've got a lot of stuff. You just got $50,000. Sorry, you've got $50,000 in credit card debt, but you just got a bonus of $50,000. What's your move?
Oh, man, I was in bad shape if I had $50,000 of credit card debt.
Hey, it depends on who you are.
Well, and it depends on why, right?
Sometimes I have $50,000 of credit card debt, but then I pay my bill down.
Yeah.
I mean, it's not really that high, but sometimes I'll look and I'll be like, oh, the business. Now, to be clear, that's a business account, and we pay it down every month. So not quite the same, but let's just say. So in this situation, it's hard to assume you're you, because that's not really your situation. So maybe you could assume you're like a 32-year-old physician or almost physician, right?
Mm-hmm, mm-hmm.
And you're making money, but you're still like just not quite getting ahead at this point. You got this extra $50,000 in bonus. You're finally starting to see a little bit more. Do you go buy a car? Because you're like, I've been working my tail off for the last 5 years just to get to this point. Do you say, you know what? I'm wiping out all of my credit card debt immediately, just getting it off my back? What do you do?
I would first thing I would do is look at the spectrum of investment opportunities I have. Because if I'm paying, if I have that much, maybe it's 20% interest on that or something, then, but I could have a cash flow from an investment that matched that or exceeded it. Mm-hmm. Then I might consider that. Now, it would need to exceed it though, because I wouldn't want to just keep up with the interest and carry that 50,000 balance, right?
Well, I'll say this, even if that's the case, Rod, if your underlying asset is appreciating, you could argue that even in that situation, mathematically, you'd be further ahead. So I have to just tell you, Jarvis, who helped me put these together, actually said you got 50,000 in credit card debt and you got a bonus of 100,000. I just thought that was too easy to say, okay, well, I'll pay off the debt and then on. So I adjusted a little bit. I think this is a good conversation, though, because that's an interesting strategy when it comes to debt. A lot of times people are uncomfortable with debt when, even regardless of what that debt looks like, right? And oftentimes it's because they had it beaten into their brain that debt is bad. But again, like if somebody comes to me and they have a student loan debt and they're paying 4% on it, and they have the money that they could just go and pay it off, or they could, on the other hand, invest it and create something to pay. You would make a very compelling argument that carrying the debt ongoing, investing the capital would do a lot more for you. You know what I mean?
Yep.
So anyway, I think that was a really good one. Okay. I don't want to spend too much time on that one. Let's move on from this one. I'm going to get into a couple of tough situations. Okay. So, Rod, and these are very real situations. And actually you've been in some of these. So, but you've invested in a real estate deal and it's losing money. What do you do? Take it like a man?
Well, I mean, okay, so here's the thing. Going into any investment, you have to know that that's a possibility. So for planning purposes, you want to make sure you have liquidity, because if it's losing money, but you see a path, like more capital gets you to a place where you get to a good place again, where it's increasing, it's creating the cash flow, however that happened, then it would be worth tapping into some of the liquidity to kind of buoy it up so it can get to a good place again. But I have to say this, I think there are situations where if you don't see that path, you have to be willing to walk away from that. And it's hard to do, because you don't want to lose the money you already put in, but you also don't want to put good money after bad, right? If it's just not going to work and not save it. And I know in kind of describing this, I'm really hitting on the dilemma.
This is a realistic issue. A lot of people are facing.
Couple of years. Yep.
Yeah, no question. Lots of certainly in the multifamily real estate space, it's been hard.
Yep.
For a lot of people, they had a lot of really, really good years, but the last couples, and especially just since interest rates, blew up, it made it really hard for a lot of these deals. Yeah. So there's a lot of people who are just actually in this situation today.
Yeah. And with very few exceptions, as I've had conversations with people, in most cases, they have had liquidity. They had that option or the opportunity to decide, whether they should put more money into it or not. And that I was grateful to see that, because obviously the worst case would be if you saw a path to where it could get to a better place, but you didn't have the capital to kind of buoy it up, and you were just stuck. Like, oh, I guess we'll just have to see what happens. That's a really difficult place to be. And so again, I think for a lot of people, they've been smart in making sure they were carrying enough liquidity to at least have that choice.
Okay, so your advice, from what it sounds like to me, is to be prepared on the front end, because really there's not a lot you can actually do. Right now, I'll say this: some of it depends on the type of real estate deal. But if you're a limited partner, then your hands are pretty well tied. So there's not a lot you can do other than determine, like, how am I going to deal with the fallout that exists from it, right? Yep. So, and the way to do that is to make sure you went into it on the front end with the understanding that investments can lose money, and so this was always in the cards as a possibility. And then, of course, the way we hope that this plays out is that it's one among many that struggles, right? So I think about my own situation, and we had the ATM deal, and that struggled, but we have a lot of other things going on. It still hurts, but it doesn't hurt nearly as much, right?
Yeah, for sure.
Okay, that was a good, tough situation. Another one, Rod. Your income suddenly drops by 50%. What's the first thing you adjust? And so let's play this out, Rod. So let's just say Money Insight's business starts absolutely tanking. Rod, we're no longer taking the same kind of income out of the business. What do you adjust in your life?
Well, this one is probably one of the ones you were referring to before when you said you've lived through some of these things, because I took a path of difficulty, let's just call it that, because coming out of college, I had a good job. I had a good career. I felt like it was stable. I felt like I was pretty well entrenched in kind of the environment, specifically marketing inside of the construction industry. I was working for an engineering firm at the time, but tied in with all the other kind of marketing groups and getting calls of offers to come work at this place or that place. And I walked away from all of that to buy a business. And this was in 2007. And it turned out to be really poor timing to do that. Now, had I stuck around in the construction industry, it's not like they were, all roses and everything over there during the recession either. But the point is, I made a decision that kind of put me in a place where it led to that. And man, gratefully, so I'll say this, my wife has always been amazing, and in like just managing funds, making the most of what she has, being frugal.
You guys are incredible
kind of the way
at that,
she
by
was
the way.
raised.
Yeah.
So
yeah. You guys are like, well, let's put it this way. I've probably modernized too much on that. And you guys just keep some of those. Are you guys still growing a bunch of stuff? Like, you guys always have a garden, and I remember you guys used to do hay. That was wild.
It was wild.
Living on 5 acres or something crazy.
Yeah.
So you were living off the. But one of the things that stood out to me when we first met, because again, you had already made that transition, so you guys were living a very frugal lifestyle. Mm-hmm. Now, I'm not saying you're not pretty frugal today. That's just who you are. But you were living a very frugal lifestyle. I remember that car. I'm I don't know if this car is going to keep running, Rod.
and really, we pushed that one to its outer limits. But actually, one of the things that we did is we sold our van. So we had a nice van, which was we had it because
that's great,
because it was when we were doing the construction, or not construction. The company I had was a furniture business, right?
Oh, yes.
I had to deliver and whatever furniture, so I had a pretty nice van that we used that also was a 12-seater, so we could fit all the family in there when we needed to. And so
know.
we sold the
You did
van
what you had to
and
do.
downsized and, whatever. So, so I feel like we've lived through similar kinds of things, but usually now, if it was only a 50% cut, then man, we'd be in better shape than we were at the time. But anyway, I think, the easy things to do would be cut back on some of the subscription type of stuff. We just our TV subscription, for example, we don't watch a lot of TV, but you have to have the right package that has the right sports channel so I can watch my team, right?
Yep. It's
and that's
tricky.
an ever-changing environment. So I have all these add-ons.
Yeah, and you just got, there's always stuff. And I mean, like subscriptions is a good one. Obviously for you, it's probably not a big, but like, going out to eat and those kinds, they're pretty easy to do. But the reality is that you just have to be willing when those moments come to make the cutback. Now, the good news is for someone like you and a lot of people listening, like 50% would still probably mean that they're fine, right?
Yeah.
But again, like I think at the core, you just have to decide. You kind of look at the board and determine which things are the most important to you, right? And which things. And when I say most important, I don't just mean money wise. Like, what are the most important to me? Like maybe date night, right? Let's just say date night where I go out and we have a nice dinner, whatever it is. That's really important. Maybe that's not one that we want to cut out, even in that kind of a situation, right? So my thought is just like some of this is financial, some of this is about overall quality of life. Now, you might be, if it's drastic enough, then you might just have to cut out any of the extras for a period of time until you can get back on your feet. But
but you can get creative with that, right? You still have the day, and again, so this is what we tried to do is have that date night, but it was okay if it was a walk, right? It was okay if it was just a drive up the canyon or whatever, and just whatever stuff like that. Just having that time together, but not going out and spending a bunch of money.
Okay, Rod, we're going to continue to move. We're moving on, but that's good advice. Listen to Rod. He's been married a long time, good relationship. So we're moving into relationship advice, date nights, and it doesn't have to be something crazy expensive. It could just be a walk in the park. Yeah. Ask Rod. That's how he's done it. Okay, Rod, our next one, we want some takes on financial strategies. Now, some of these are kind of obvious, but I just feel like it'll kind of spark a conversation around it. Okay. So question number one, Rod, is paying off your mortgage early a smart move, or should we focus on investing that money?
I think investing is way to go. Because even the thing I was thinking in my mind, okay, well, it's easy if you have a 3% interest rate on your mortgage to say investing.
Yeah. What if it's 5 or 6?
Well, but that's kind of where I started going is even if it was 5 or 6 or 7, people are probably right now at 7.5 if they got it at 2 years ago, whatever. But I still feel like that it's not hard to find investments that consistently pay out higher than that so that you can justify it. And kind of going back to what you said earlier about for a lot of people, there's just that mindset of I hate debt. I want to get rid of it no matter what. And I think you can do both, meaning you can go out and invest it, but you can do it in a place where, so let's just say it was like a debt fund or something, right? That pays out 10%. Well, 10% is bigger than any of the numbers we talked about, right? Even the 7.5% interest rate on a mortgage. But you would be picky because you would only pick a debt fund that is liquid. You could cash out of anytime you wanted to, because if you have that mindset of, man, I just hate debt so much, well, then have an asset that you could use to pay it off at any time if you needed to, kind of mixing this with the previous question. Well, I don't want to get in a difficult financial situation where I lose my house. Like all of a sudden I can't pay my mortgage because my income went down or whatever. Okay, great. Well, have that money in a place where you make up for that, right? You have access to it. You could pay it down or use that liquidity to just cover the mortgage until you get to a better place from an income standpoint. So being smart about it, but I just feel like long-term, creating really financial stability is what you're after when you're paying off that debt anyway. Well, you can create some really cool financial stability by investing it somewhere and having it growing for you at a better rate than what you're paying on the mortgage.
I like the idea of tying an investment to your debt. If you're someone that just struggles with this idea of like, am I dealing with my debt? Then when you tie them together, you can use it like a net value, right?
Yeah.
So instead of just looking at this asset as a negative 50,000 and this one as a 100,000, I can just look at the asset combined and so there's other ways that you can get to. Now, let me throw a wrench in this, Rod, because we just talked about the fact that some people have lost money on investments, and there is an element of risk that I get with taking on an investment that I don't get when I pay off my debt, right?
Yeah.
So when you think about that, like, what's your rebuttal to someone who might say, and really this is about you. So what's the rebuttal in your mind about how you
in my mind? Well, here's the thing is that people, you would think paying down your mortgage is a no risk thing. Like it's an improvement on risk rather than, taking on risk. Right. And yet, let's say we'll go back to the same scenario, right? Let's say I've used all of my excess income or expendable, resources to pay down the debt, and then I take the cut in pay, so much so that I can't keep up with my mortgage payment. Well, guess what? If the bank ever has to foreclose on the home, I lose all that money extra money that I put into it, right? Because in other words, whether I owe 10% on my home or whether I owe 90% on my home, when they foreclose, I lose it all, right? All of that equity that I had. So if you're not smart about it, and because here's the thing that I know that I've seen, like I've been in homes, I've met with people who were paying extra on their home, but they weren't also doing other things like making sure they had an emergency fund, liquidity, other things going on. They were just they hated it so much. They hated that debt so much that they were just putting everything towards paying that down. And that was really risky in my mind.
Yeah, it absolutely is. Right. If everything's going into an asset that especially if you don't have it completely paid off, because now you're in the situation, like you said, if you lose job, you lose the ability to make the payment. Doesn't matter, like you said, if I owe $10,000 on it or if I owe $1 million on it, still taking it. Just wild to think about, but that's the way it is. Yeah. Right. Okay. I like it.
And sorry, can I throw one more thing out there? Because the other thing people will say, well, I have that equity there, I'll just tap into the equity. But again, unless I was thinking ahead of time and already had my HELOC set up, if I wait till the time where I lost my job, I need to tap into that equity, I go to the bank. Well, there's no way they're going to give me a HELOC at that point in time.
Yeah.
Right? So I can't tap into the equity without actually selling it. And then I'm just up to whatever the market will do for me. Right.
So basically what I hear you saying is there's always risks.
Yes.
We just have to be aware of what all of those are and take them on in the way that fits for us. And you're saying for you, it makes more sense to invest the money rather than just paying it all off in a mortgage situation.
Yeah, and I am taking on that risk on the investment side, because earlier you mentioned, well, what if that investment goes away? Well, that's a possibility, right? So now maybe I took money that would have been sitting out there ready to pay off my mortgage, but now that went away. And again, I went into it knowing that was a possibility, that there was a risk of that. But again, also recognizing there was a risk on the other side. And so by measuring all the risks, then I can make a decision. But if I don't see all of the risks, and I just think, well, paying down debt is always the best thing to do.
Yeah.
I just need to understand the kind of full spectrum.
Well, and you can prepare appropriately if you know that, right? So going back to the risk of the potential risk of the investment going belly up or whatever. And to be clear, like in that type of a scenario, we're not looking for like high risk investments, right? We're not trying to chase 30% returns. We're probably, happy to get 10% type of returns, which is still a really strong, good return. But obviously, that has a different risk profile. So the point of the matter is really that we're dealing with many risks, and we have to just be aware of them and make the right, the call for us. So, okay.
Yep.
I have another one, Rod. We're going to do one more. Okay. I have a feeling that this is a conversation, a topic that you're going to know a lot about. I did not create these questions, by the way. Well, I created some of them. Jarvis helped me. Anyway.
Jarvis knows you very well, though. So
Jarvis knows me well. Rod, what's your take on premium financing for life insurance?
Okay.
And when does it make sense? And maybe when does it not make sense?
Yeah. Maybe I'll start with the second one. When does it not make sense? I think if you're early on in your financial journey, and even if you're a really high income earner, I wouldn't jump in with premium finance as my first thing.
Okay. So so you're saying, I just want to make sure I'm really clear on the first part is don't make it your first move. It's probably not, it probably shouldn't be your first move. Okay. Fair enough.
Yep. Your first move. And then also I would say it wouldn't be my only move. So in other words, we've talked about this before, right? It's a lot of people will look at the spectrum of all the different options they have to invest in. They see one that's the best, right? The quote unquote best. And so then they think, well, I'm just going to put everything into that. So even if I looked at premium finance and I said, I like that better than everything else, still don't put all your money into it.
Okay. So maybe not our first move, and it's not our only move.
Yeah.
Okay. I like it.
Okay. So, but then for those who have created a kind of stable financial foundation, maybe you are investing in a variety of different things, then premium finance can be a great additional piece, right? One of those, because it carries risk, right? We just talked about this. Everything has risk, but I think it carries a different risk profile than investing in real estate or your business or a lot of these other things, oil and gas, right?
Well, and the risk is not just different in the sense that it's a different asset. It's different in the sense that the life insurance itself is just pretty foundationally solid, right? Like I would say in terms of risk between any type of real estate deal and putting your money, like life insurance is about as solid and strong of a foundational asset as you can. So where the risk lies is actually in the managing of the debt.
Yeah.
Rather than in asset to asset. Does that make sense?
Yep.
That's the way that I would view it. Anyway.
And one of the things that's, I think, I'm going to say unique, there may be other things that fit this, but is that the risk of rising interest rates and rapidly rising interest rates exists in premium finance. And yet, well, and to be more clear, because of the debt, right? If the interest that I'm carrying on the loan side, all of a sudden the interest rate goes up. Well, great. Now I'm carrying higher interest on that side. But what also happens is a rise in interest rates increases the returns that I can expect to get from the life insurance, right? And without getting into too much detail on the whole life side, the dividends go up in a rising interest rate environment with a lag, of course, but they go up. On the IUL side, the caps go higher. So I'm capturing more of the upside of the market when it's rising, when interest rates go up. So because that shift impacts both sides, both the asset side and the debt side, it makes it really an interesting and unique asset class in that sense, because you kind of mitigate that risk just by the fact of what it is.
Yeah, that's a good point. Okay, so maybe let's go through just for helpfulness. We'll say for helpfulness, Rod.
Okay.
Tell us what are like the outcomes and situations where someone would want to use it. I get the things that you talk about every day with clients. Why are they, if I'm XYZ client of yours, Rod, why am I doing this? What am I getting at? What's my value proposition?
Yeah. So there are basically two primary outcomes. There could be some ancillary to this, but I think it's really two things. Either we're building it to produce tax-free income in the future. And when I say in the future, it's typically 10 years or more in the future. We can front end load it more to kind of move that timeline up a little bit, but typically think of it that way. Either way, it's down the road. It's not something you put the money in and immediately you're going to start taking the income out.
Yep, and that is important. Like that.
Okay. So that's one. And again, tax-free income is a big part of that. A lot of why people like it as well. The second piece is that it's a really good estate planning play. So whether or not someone likes the income side of it, but they're wanting from a legacy standpoint or estate planning in general, they want to have a large amount of liquidity come into the world of their heirs when the time they pass, then it can be a really good way to amp up the death benefit. And I'll give you a really quick example. We have a case we're working on right now where when they looked at just life insurance by itself, with a certain amount of assets, it was going to create roughly $13-14 million of legacy death benefit when they pass. Okay, just based on life expectancy. When they looked at premium finance, it turned that into more like 40 million. So that amplification, we talk about the spread between what I'm earning and what I'm accruing in interest on the loan and those kinds of things. And that's often really when we're focused on the income side. But in this case, because specifically they were looking at legacy, then it was like, oh, well, we can 2-3x at least, if not more, this death benefit by doing the premium finance. And that's huge.
Yeah, that's massive. Okay, cool. I have I think I said I had one more last question, but I have one more again, Rod. If you could invest in only one thing for the next 10 years, what would it be?
One thing. I'm probably taking the easy way out.
And that is real estate.
No.
Okay, good. Tell me. Oh, okay. I should have seen that one come. I was hoping you were like, I'm all in on crypto, going every dollar in on crypto.
Yeah, and
we do know people that are all in like that on crypto.
For sure.
You never know.
For sure. And here's the reason I say that is just because I haven't seen any better return on dollars that I've put into anything other than our business. And so if we could do the same, if we could
accomplish the same objective over the next 10 years, then that would be pretty dang good.
That would be the best place to put it.
So. I like it. That's a good thought. Okay. I think we'll close it up for today. I do have a bunch of other questions, so they're very well maybe a what would Rod do part 2. But I think this is a good closing point. So thanks everybody so much for listening to us, and we will see you next week.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.